And Mr. King, I give you the floor.
Shukran. Sabah al khair. It's very nice to be back in Cairo. I'm sorry I can't deliver the entire speech in Arabic, but I will talk to you about the topic that His Excellency, the Governor, introduced this morning, which is we are starting to see some inevitable changes, some very rapid changes in what we define as banking. And this is going to change the way we think about the bank account itself. And this is a pretty big shift. Movin Bank is my startup. It's a digital bank. The governor mentioned the formation potentially of digital banks here in Egypt. It was founded in 2011, but I've been in the banking sector for many years. But I think if we're going to talk about the changes that will occur in banking, we need to set some baseline understanding of the changes that have been occurring progressively to banking over time. And we need to frame this in the fact that this is not something that is just happening now. It is something that's been happening for many decades, but the internet and mobile technologies have started to accelerate that. So let's start by talking about, I'm having some trouble with the clicker here, but could you advance the next slide, please? Yes. So this is what we used to think of banking. The Bank 1.0 world really came into existence about 700 or 800 years ago in Italy. This was the center of banking in the world at this time. Now, this is the oldest bank in the world, Monte dei Paschi di Siena. Did I get it right, Matteo? Yeah, pretty close. Yeah. 750 years old, this bank. It's based in Siena in Italy. And if you go into this very old historic building, you can see the setup of what looks like a historic bank branch for Monte dei Paschi. And when you look there, you see these tables and you see some cast iron work, looks like a teller window. You can recognize it immediately as a bank branch. 700 years old, and this modality of banking really hasn't changed much in 700 years. So this, if you're looking for changes to this, to the banking world, this really started with, next slide please. This really started with the introduction of the mainframe technology back in the 1950s. The first mainframe was built by MIT, the university in Boston, for Bank of America. Sorry, can we go back, please? Okay, we'll let them sort that out while we do this. So this was the first technology introduced to banking in the 1950s. And the reason for the introduction of this was in the United States, the use of checks was growing rapidly, so quickly that humans could no longer keep up with the volume of transactions that were occurring. We needed machines. But the computers back in those days were not very smart. And so we created this ability to store transaction information, the check details, but we couldn't sort these transactions very sophisticatedly. So what we had to do is we had to give every transaction a number. This was the check. And every customer had to have a number. And this was the very first time in history we used bank account numbers when we introduced mainframe technology. A few years later, we talk about the Bank 2.0 era. Now, this is sort of starting in the mid-80s and 1990s. And it started with the introduction of ATM technologies and then followed on with the technologies of the ATM machine. So if we could have the next slide, please. Yes. So this was the first time we had the concept of introducing the ability for people to do banking without having to go to a bank branch during the opening hours. And this was a start of us extending the service concept of financial services and banking, but it was really starting to detach the need for centralized banking systems and starting to focus on customer interaction, day-to-day customer interaction. Now, I know I'm talking about retail banking a lot here, but the same applies for other aspects of financial markets. Stock trading, for example, in the 1990s underwent a very big shift away from face-to-face interactions or the use of the telephone with brokers to electronic trading systems. So this was all part of this shift away from this dedicated human interaction to get access to financial services. Then for Bank 3.0 era, this really started when Steve Jobs created for us the iPhone platform. Now, why this was different to other phones in the past and other platforms in the past is you could carry it with you. So now you could have access to banking anytime, anywhere. You didn't have to be at home, you didn't have to be at the ATM machine. This was a technology that allowed us to, thank you very much, we'll see if we can fix this problem, to detach almost completely from the traditional view of bank distribution. But for many banks, they were still very much geared toward, you must come in the branch and sign a piece of paper to get access to banking services. And this was a key shift here. So the big question is, what happens next with the technologies that are emerging? So Bank 4.0 era is really where we start to move away from the bank products and services that we used to deliver through the traditional distribution mechanisms, and we start to embed the utility of banking in our world through technology. Now, one of the most promising technologies you're going to see me talk about today is voice smart assistants using AI in a voice basis technology. But in 10 years' time, this sort of technology, augmented reality glasses, where you can get data in a computer in your glasses displayed in your field of view, will be quite common technology in just 10 years' time. Now, as technologies like the mobile phone, a voice AI, or smart glasses emerge, banking has to be instantaneous, delivered contextually based on what you're doing, based on your life. And this is a very different concept of the way we've thought about banking, because we've always thought about banking as highly regulated, and you must do KYC. You know what KYC stands for, right? Kill your customers with paperwork, right? Yes. This seems to be the rule. And so we've always thought you must come into this process, prove who you are, and then and only then, once you've identified yourself, can you get access to banking. But I want to show you some lessons we've learned from other areas of the world. When technology innovations occur, the most rapid changes to markets don't occur with small incremental changes from an innovation perspective. The biggest innovations throughout history have come from what we call first principles thinking. This is when someone says, why do we do it like this? Why are we getting on a horse to go from point A to point B? Why can't we build a motorized form of transport? This is what we call first principles thinking. And I want to share with you an example of first principles thinking that illustrates the type of transformation that is going to occur in banking. I'm going to use rocket science to indicate this. So this is the V2 rocket. At the end of the Second World War, this was the height of technology being developed around the world. This, of course, was a weapon developed by the German forces. But as the war drew to a close and it was clear the Germans were going to lose, the Americans, the British, the Russians rushed into Germany to try and capture the scientists that had worked on this program to get this technology. And at the top of the list was this man, Werner von Braun, the creator of this program. Now, he ended up going to the United States and became the father of the Apollo space program. And of course, this at the time was the most expensive national program ever outside of wartime ever conducted. And every launch of the Apollo program was about $1.2 billion in today's terms of costs. That means it cost about $6,000 per kilogram to get a kilogram of mass into orbit. And for 50 years, we tried to improve and improve and improve on this technology, and we reduced the cost of orbit by half since the days of Apollo. But this was iterative approach. We took the V2, we improved on it, we got the Apollo rocket platform, then the space shuttle. Every time we made small improvements with new technologies. But recently, along has come a company called SpaceX, Elon Musk. And he's going today launch the Falcon 9 Heavy, the largest rocket ever launched since the Apollo Saturn V. And the cost to orbit of the SpaceX rocket will be $300 cost to orbit. That's a 95% cost reduction. How did Elon Musk achieve this? He said a very simple question. He said, if we were going to build rockets today, would we build them the way Wernher von Braun built them in the Second World War? And the answer was no. He said, how do we use computer technology, 3D printing, material sciences to build something more efficient? A rocket that can land itself after it's been used so we can reuse it. Now, can you think of any other products that have taken this sort of approach to design? What about the iPhone? Before a smartphone like the iPhone, which phone did you have? Did you have the BlackBerry RIM keyboard? Maybe the Nokia banana phone or the flip phone? These were the phones that were common before the iPhone. The iPhone was a game changer because Steve Jobs didn't think about redesigning those phones. He said, how do we start from scratch? How do we take the internet, MP3 player, software platform, and a mobile phone and combine that into a touch device, a personal computer you carry that's different? And this is first principles thinking. Now, in banking, we don't use first principles thinking. When new technologies come along, what we do is we take the bank branch model and we say, now we can deliver the branch services on the internet, on a mobile phone. And let's take internet banking, for example. When internet banking first came along, we were worried about cannibalizing branch business. So instead of selling bank products and services on the internet, we said, what can we put on there? You know, we can't sell because the branches sell. We don't want to disrupt that business. What can we put on the internet? And someone said, I know, we can put bank statements on the internet. So that was version 1 of internet banking. You could log in and you could see your bank statement, right? And then we added transfers and things like that. And when mobile phones came along, what did we do? We didn't say, oh, this is fantastic. We can do new things with mobile we've never been able to do with the bank branch before. We said, great, let's put our bank statements on a small screen. This is this iterative approach. We're trying to take the bank branch and implement this on these technologies. And this is a good example. When Apple launched Apple Pay, instead of thinking about payments in a very different way, we just stuck a plastic card inside the phone. This is not first principles thinking. This is what we call design by analogy. And the analogy in banking that we design all of this technology around is the analogy of the branch. This is how we start. But if you're thinking about launching a different style of banking, how might you go about it? I want to use this video. This is Jack Ma, the founder of Alibaba in China. And I want to play this video for you. This is him talking about competing with Walmart. And this is first principles thinking about customer acquisition. Let's play the video.
You know, you do a great job. And blah, blah, blah. So I said, maybe in 10 years we'll be bigger than Walmart. You say, young man, you have a good hope. So we said, make a bet. I think in 10 years we'll be bigger than Walmart on the sales. Because if you want to have 10,000 new customers, you have to build a new warehouse and this, that. For me, 2 servers.
So if we think about the problem of financial inclusion, in countries like the United States and other countries around the world, we thought the solution to financial inclusion was to get people into the branch. But the United States doesn't have 100% financial inclusion. More than 20% of households in the United States are excluded from the financial system. This is despite having one of the highest branch densities in the world. And yet in recent years, we've seen M-Pesa in Kenya, we've seen China, other markets, non-traditional, advanced markets from a banking perspective, suddenly have rapid changes in financial inclusion. This is another good example of first principles thinking. Alibaba launched a deposit product in China called Yueibao, and they launched this, and over the space of 8 months, they achieved $90 billion of assets under management. Massive growth. And now that's double that now, 180 billion. It's the largest money market fund in the world. This is the largest deposit product ever we've seen in history. Now, this is interesting because in the past, we would have said we needed bank branches to take deposits. But it turns out the mobile phone is far more effectively at enabling this type of behavior. 180 billion in deposits in just a few years. Which branch network in the world has achieved that? So this is how Jack Ma thinks. If you want to include people in the financial system, you deliver banking in real time on a mobile phone. He doesn't ever think about getting someone into a building to sign a piece of paper. So if you're going to compete in the future as a bank, you're actually not competing against other banks. You're competing against first principles thinking when it comes to financial services. Now, we've often assumed that the branch will remain central to banking. And so we've tried to redesign the branch to cope with these technology changes. This is a good example from Supendu's market in Singapore. This is OCBC's Frank. But these design changes we've done have not stopped people from abandoning day-to-day banking in the branch. It's not a design issue. It's not about enough technology or having good coffee machines or comfortable couches to get people back in the branch. The fact is, now that we have this, we don't need to go to the branch as much as we used to. So it's not a design problem, it's a behavior problem. The only way to get people back in the branch now is to take their smartphones away from them, and that's not going to happen. So when we think about design in the space, the problem we have as bankers is we think about digital as an extension of branch. This is the previous CEO of RBS. He said, our biggest branch is the train from Reading to Paddington. He was saying the mobile app is their biggest branch. So this is how bankers think about new technologies we introduced into banking. They think about mobile, the internet, as a digital form of the branch experience. Jack Ma and these other players in the system don't think like that. They think about how can we deliver financial services on this platform in a different way. So one example is Uber. Uber in the United States was trying to recruit drivers, and they couldn't grow fast enough with the existing banking system because 30% of drivers that went to Uber's app to sign up didn't have a bank account. They'd been working in the taxi industry getting paid in cash. Uber could not pay them in cash. So Uber included in the app an option for signing up to get a debit card. This simple thing made Uber one of the most successful banks, if you like, from a customer acquisition perspective in the United States for small business accounts. But Uber doesn't want to be a bank, but they needed banking built into their system to grow their driver platform. So this is the experience of banking. This is not, you don't go to Uber to get a bank account. You go to Uber to sign up as a driver, and they enable the banking stuff around it, whether that's getting a bank account or whether that's leasing a car. So this shift is from bank products to experiences. This is the Tencent WeChat payment experience you might see around the world. They're in 77 countries already, and you can see that there's no traditional point of sale, there's no plastic card involved. That's not how WeChat designed this. They just designed you to use your phone. So this is a payment experience. It's not a payment product. You don't need to sign a piece of paper in a bank branch to get access to this. It's just pure utility. So this is really what technology is doing to banking. It's stripping away the traditional distribution mechanisms and the products we had, and it's creating a way to surface the utility of banking more efficiently in real time. So if you think about it from a retail banking perspective, we only really have 3 products in retail banking. We have value stores, the ability to store value, deposit. We have payment rails, the ability to send money and move money. And we have credit access. And in the past, in the branch, we wrap different product wrappers around that. A mortgage product, a credit card product, a line of credit or an overdraft. But in the technology-based world, we will deliver the utility of credit without needing a plastic credit card, without calling it a credit card, because it doesn't make sense to call it a credit card when you can do it in real time. So you might walk into a grocery store in the future, and the way it works today is if you go up to the counter, you don't have enough money, you'll be refused because your debit card doesn't have enough balance. And then you'll have to look for a credit card to buy your groceries. But in the future, when you walk into the grocery store, if we know you don't have enough money, we'll offer you credit when you walk in the store. We won't ask you to apply for a credit card or an overdraft. We will just instantly give you access to credit. This is the world that's coming. It's not a bank product that we sell as an offer through the mobile. It's the utility of credit that we provide in real time. Now, as these technologies improve, for example, with smart glasses, more and more emphasis is going to be on banking experiences that are contextual and real time than the bank products we used to have. And this is going to be the primary competency we need to develop as a market in the future, building compelling real-time banking experiences. So when you talk about a digital bank is not a branchless bank. It's a way for utility of banking to surface through technology. That's the shift. Now, I want to play this one video for you. This is the next technology we're going to have to deal with as bankers. This is using Alexa or Siri voice smart assistants. And I want you to understand how this changes interactions such as payments. Let's watch Alec Baldwin demonstrate how to buy something using Alexa.
Yeah.
You're okay. He's okay. He made it.
Jason, what do you mean?
We were very bad boys.
Alexa, what's in the news?
Here's the news.
Alec Baldwin and Jason Schwartzman were seen mooning paparazzi. Baldwin threw his shoe at photographers before making a run for it.
My poor cashmere socks. Alexa, reorder another pair of Brescianis.
Reordering Bresciani socks.
Okay, listen. Can you send some lawyers or something?
Alec.
Now, I'm going to test you. What did Alec Baldwin order using his voice? Socks, right. Now, which credit card did he use? Which bank credit card? We don't know, right? Because he didn't say. He has obviously configured with Alexa. But today, in terms of how we design credit cards, we design them around the system of, we want you to use them more, so we'll give you rewards or cash back, to stimulate the usage. So now let's say that Alec Baldwin has a HSBC credit card. But it's not the one he normally uses with Alexa. And this month, there's special airline miles from HSBC. So let's replay this. Do you think he'll go like this? Oh, my poor cashmere socks. Alexa, reorder me a pair of Bresciani socks. But wait, HSBC has special airline miles this month, so let me give you a different card number. 5734. Did you get that, Alexa? Do you think that's the way he's going to do it? No. You see, we are going to have to redesign those products and services to fit into this world. The existing bank's products and services won't transition into a real-time world like this. So then we have to ask the question, Where do humans fit into this? Because we've always thought that humans will differentiate the experience. But the advice we'll get from this technology layer in the future is going to be very different from in the past. FinTech advice is real-time contextual advice. Like, hey Siri, can I afford to go out for dinner tonight? Hey Siri, how much do I need to save each week to be able to afford to buy a new home next year? These are the types of contextual advice we'll see this technology deliver for us. Think about it like a self-driving car. Think about advice like a self-driving car. This is what a self-driving car sees with its technology as it's driving along the road. It has LiDAR or radar detectors, it has cameras, and it can see 1,000 times more information than the human eye. It can see further, about 4 times further than a human, especially driving at night. And it can respond to an instant, an accident or something like this, in half of the time that our human brain can respond. So once this technology is mature, it's going to beat human drivers, even on the Cairo roads, right? Now, this is because the AI that drives this can absorb more information and process it faster to make a decision. This is the problem humans are going to have in this future world, because AIs will be able to give us advice, better advice faster than a human advisor could give us. They're going to have an advantage, an information asymmetry advantage. They're going to know more information and be able to decide faster. So Elon Musk says, applies this in the motor vehicle industry. He says, the reason we have to have computers, robots, manufacturing vehicles is if we have humans on the factory floor, we have to slow down the production process. So I want you to think about this in banking terms. For financial inclusion, for the future of digital banking, humans will slow down the ability to create inclusion, deliver financial products, deliver advice. The technology layer is going to be more efficient, especially when it comes to delivering revenue. The most profitable banks in the future will say, no more humans. They slow it down too much. This is the world we're moving into. We're seeing blockchain emphasized more and more. This is a company called the Sun Exchange, which uses, they deploy solar panels. And for every kilowatt of energy, they generate a solar coin. You've heard of these tokens, right? And this solar coin is called a Ra. That's a good name for a solar coin, right? And you can exchange this for US dollars or Bitcoin, or you can reinvest in buying more solar panels. The solar panels sit on the blockchain and are managed by an artificial intelligence, not by a human company. This is the type of infrastructure that we're starting to see created side by side with core technologies that are going to be part of finance in the future. But maybe let's think about payments in a consumer environment with a self-driving car. You can imagine this self-driving car on the roads, maybe in Dubai. They're going to be one of the first cities that will do this in the region. And it has road tolls to pay. It maybe pays tax. And maybe it drives for Uber. A self-driving car can log on and say to Uber, I'm available. Log on to the network. I'll drive for a few hours. It can drive and get paid for being an Uber vehicle. But what about the bank account in the self-driving car that does all of these payments? Do we need to get the car to the branch to sign a signature card? See, this is why we have to think differently about this infrastructure that's emerging. So the fintechs that are emerging are first principles creators of financial service experiences. They create these technology-based banking experiences faster and cheaper than most incumbents. This is why in markets like today, we saw this agreement signed in Singapore, in Hong Kong, in London. We see more and more regulators opening up markets for fintechs because they move the market along faster than relying on the incumbents. Fintechs can deploy capital faster and cheaper than incumbents because they're smaller organizations, they don't have legacy systems, they don't have compliance legal teams like we do within the banks. So this innovation within fintechs occur faster. But fintechs also have a problem. They need revenue and scale to grow. So partnerships are forming between fintechs and banks to create the best of both worlds in this instance. And this is really where we see these two worlds colliding. So I'll leave you with this thought to finish up. If you take a first principles look at financial services, you'll see new players emerging globally that are really significantly influenced. The biggest bank in the world, in just 7 or 8 years' time, will probably be a technology company, Ant Financial, Alipay. They're aiming to have 3 billion customers around the world. They're in 100 countries already. By the middle of next decade, they most certainly will be at a higher market cap than ICBC, the largest bank in the world. But they're not a bank. They're a technology company. But when it comes to customer acquisition and day-to-day banking experiences, this is who you're going to have to compete with in the future. So let me leave you this one final thought. If you were starting from scratch today, if you wanted to build the banking system and you didn't know what banking systems were like in the past and you were starting from scratch, would we really build banks with buildings that require you to go to that building, present all of these identity documents, sign a piece of paper to get a physical card or a checkbook to do your day-to-day banking? If we were redesigning banking from scratch today, is this how you'd build it today? The answer is clearly no. So then the obvious question is, why are we still doing banking like this then? And that's really the principle behind Bank 4.0. The book is coming out in May, Bank 4.0, so I hope you'll all have a chance to read it. But it's my pleasure now to kick off a couple of discussions on panels to dive a little bit deeper into this collision between fintech and the banking industry. And we'll invite our panelists up now. Thank you.